Hello, Assalamu alaikum. My name is Danish Kazdar. So, today we are having our third lecture, and today we are going to discuss the fixed assets and a few more topics. So, fixed assets is basically a very important topic, and IAS 16, International Accounting Standard 16, covers the fixed asset which are known as property, plant, and equipment. So, here we would discuss what is capital expenditure and revenue expenditure, which is often known as capex and opex. Secondly, we would discuss the depreciation and how it works. Then we have the revaluation concept. Then what are disposals and what is a fixed asset register. So we would just start by a few definitions. These are definitions which are given in the IAS. So property, plant, and equipment are tangible assets that are held by an entity for use in the production or supply of goods or services for rental to others or for admin purposes and are expected to be used during more than one period, which means that these assets are usually held for more than 1 year. And here are some of the definitions. I would not go into big details here, but we would discuss its concepts. So, capital expenditure is basically an expenditure which results in the acquisition of non current assets, and this expenditure appears in the balance sheet. So, the balance sheet, as you have already learned about, that it is assets is equal to capital plus liabilities. So all the assets are mentioned in the balance sheet. On the other hand, revenue expenditure is expenditure incurred for the purpose of trade or to maintain non-current assets. This is expensed out in the P&L statement. So the day-to-day expenses, what we call the routine expenses, are mentioned in the profit and loss statement. And both these statements are very important for any company or sole proprietor or whatever it is, because the balance sheet will show you your business position since inception, and the P&L statement would show you your profit or loss for that specific period. And the importance of bifurcating capital and revenue expenditures, because there is a reason, and that is basically what we call as materiality, and because then there are certain rules and certain principles on which you have to recognize expenditure as capital or revenue. And if you do not follow those rules, your financial statements would not be presenting a true and fair view to the users of financial statements. So here we are discussing what is known as capital or revenue expenditure. So here you would see some of the expenses. So for example, if you purchase a property, you just think what type of expense it is, revenue or capital. So of course this is a capital expenditure, because you are purchasing a property and it would be reflected in your balance sheet. The depreciation is a revenue expenditure and it appears in your income statement. Lawyer's fee in connection with the purchase of property. So we would discuss in the IAS that whatever uh, uh, expenses are incurred in relation to bringing the asset into a working condition, all those expenses are recognized as capital expenditure. The cost of adding extra storage capacity to a mainframe computer used by a business, then there are repair and maintenance, all these are revenue expenditures. And cost of a new plant, it is a capex. Then you would see wages of machine operators, this is also routine expense. Now we would discuss depreciation. Depreciation is a very important concept, and it is an example of matching concept, which is basically it is an expense which is charged on the basis of the useful life of an asset. So for example, if the cost of asset is 100 and its life is 5 years, then the depreciation expense shall be charged as 20 per year. Hence after 5 years that asset would be shown as nil or at $1 in the balance sheet. It is basically spreading the cost of an asset on a systematic basis, that is useful life. So the whole concept is to spread the cost of asset on the basis of a useful life. Now there are two things. There is something called useful life, and then there is economic life. In accounting, we would be talking about useful life, because we we may have come across in our real life that, for example, if you use the example of motor vehicles. There are some people who have been using the same vehicle for like 15-20 years, but for accounting purposes the companies use a policy, and that is useful life, which means that the life of the vehicle would be considered as a 4 year, 5 year, 6 years, and not for a long period of time. Anyways, that was something on a side note. And this is the official definition. Depreciation is the allocation of depreciable amount of an asset over its useful estimated life. Depreciation for the accounting period is charged to profit and loss for the period directly or indirectly. Now there are two types of depreciation method. One is a straight line, which we discussed earlier, that if the cost of asset is 100 and its useful life is 5 years, so its per year expense is 20. However, there is another method which is called the reducing balance, and that uses considers a percentage. And so these are the disclosure requirements which are required to be disclosed in the financial statements. So we discussed this method of depreciation: cost less residual value divided by expected useful life. And reducing balance uses a percentage of the carrying value of the asset at the end of the previous accounting period. So here you have an example that that vehicle was bought for a business which cost 17,000. It is expected to last 5 years and can be sold for scrap for 2,000. So simple straight line method would be 17,000 minus 2,000, which means 15,000 divided by 5. So that would come to 3,000 per year depreciation expense. Now this is the way in which a non-current asset is reflected in the balance sheet. So you can see that the cost is here 2 million, and then you have the accumulated depreciation presented separately, so that the user of financial statement has clarity that what is the cost and accumulated depreciation. Accumulated depreciation is a type of negative asset, which means that it is the contra of an asset and it is deducted from the asset. And this is how it would be shown as balance sheet. So this is also a way to show, but here you are seeing that it is the net values, and these amounts have been deducted. So this is the presentation. However, a better presentation is to show this accumulated depreciation figure. Now we have come to an important topic, which is revaluation of assets. And revaluation means that the asset is revalued. It is mostly land, which is often revalued, and the revaluation, if there's an upward revaluation, which that would be a debit in the asset. So for example, if the asset is worth 100 and has been revalued and now its new value is 150, so the entry would be debit asset 50 and credit revaluation reserve. So this would be reflected in the balance sheet in the equity portion. And when the asset is disposed of, the method of calculating a profit or loss is to first calculate a carrying value of the asset. So here a business purchased an asset of for 25,000. Its life was 6 years and an estimated residual value was 7,000. This asset was eventually sold after 3 years to another trader who paid for 17,500. So here you have to calculate the profit or loss on disposal, and I've already given you a hint that you have to first calculate the carrying value and then you have to compare it with the price received. So it would either be a profit or a loss. Now the cost of asset actually includes these items, which is the purchase price. Of course, this is the price which you bought that asset for. Then the initial estimate of the cost of dismantling and removing the item and restoring the site. Directly attributable costs, which means that those costs which are directly considered and are necessary to bring the asset into working condition. These are the site preparation cost, initial delivery, installation, professional fee. All of these become part of the cost of asset. And then if you are doing subsequent expenditure on your assets, that would be considered as a capital expenditure if they are meet this criteria. For example, if it is a modification of an item to extend its useful life, then that would be a capital expenditure and would reflect in your balance sheet. If you upgrade the machine parts to improve the quality of output and if there is a new production process leading to large reduction in operating costs. So all of this would be capitalized as it improves the condition of the asset beyond the previous performance. So this is basically an overview of IAS 16, and IAS 16 gives you two models, cost model and revaluation model, and we have already talked about both of these. And the last topic is basically in this session is the fixed asset register, which means that all the fixed assets are required to be kept in a register which should have these fields. For example, it should have a manufacturer serial number, description of asset location, custodian, who is using that asset, who is the user department, what is the purchase date of asset, cost, depreciation method, carrying value. So anyone who has a fixed asset register, he can easily assess the fixed asset position and can locate the asset with all relevant details. So hope you like this lecture, and do not forget to subscribe the channel. Thank you.